If I speak now? Yeah, perfect. Great. Let us know in the chat if you have any problems, technical difficulties with sound or image or anything like that, or if you can't hear us. We will take questions during the whole seminar, but I'll throw it over to Amanda for a little introduction.
Yeah, so with us today we have Jonathan Milläng, who is head of sustainable finance. And this is our second session of the sustainability lunch series webinars. And we have some upcoming in a few months as well. So we are happy to have you here today to listen into SFDR and the practical implementation of that. And as Jonathan said, you are free to leave any comments or questions, and we will answer them throughout the webinar. And the presentation will also be recorded and sent to you, those of you who are interested. But I leave it over to you, Jonathan, and welcome.
Thank you. With us today, we also have Emil, who's sitting on the side here, and he just tested the sound. He's also a member of the sustainable finance team here at Ethos, and will also be answering some of the questions in the chat. Today we're going to talk about the Sustainable Finance Disclosure Regulation, which is the new or semi-new transparency regulation from the EU that has been placed on financial actors solely. The goal of this regulation is to complement existing regulation on non-financial actors, for example, NFRD and the Swedish Annual Accounts Act, if you're familiar with them, as the EU has determined that if the owners and investors can set requirements on their assets under management, they think progress towards these EU goals that we have, climate neutrality by 2050, and the Paris Agreement will go faster. So what we're going to talk about today is quickly what are these new EU regulations and how do they work. We're going to focus on the SFDR regulation. We'll especially dive a little bit deeper into Article 8 and 9 as how to interpret these fund classifications and what you actually have to report for an Article 8 or 9 fund was adopted by the EU Commission only about 2 weeks ago. We'll also talk shortly about the principal adverse impact indicators that are suggested, and then have a quick summary at the end. So a quick overview of Ethos. We are about 30 economists, engineers, legal experts, environmental experts, and more. We are management consultants, but we work solely with sustainability. So the areas of human rights, environment, anti-corruption, and environmental issues, as well as labor rights. The financial services that we provide are basically the same areas that I just mentioned, but tailor-made then for the financial sector. So these include then strategy and portfolio development, adaptation, and readiness for the EU Action Plan on Sustainable Finance, which we'll go through through today, as well as mergers and acquisitions activities in the form of ESG due diligence. So if we're going to summarize quickly what it is that is driving this change then within the financial sector, we mentioned the regulations, of course, which are quite heavy-handed, and there are a lot of them, and they're very complex, but they're not the only market drivers when it comes to the integration of ESG in finance. There's also a very heavy demand from both retail and institutional investors for ESG products. And maybe the third driver that is still a bit debated in the financial sector is the value of ESG risks and the integration of those in traditional financial risk analyses in order to understand what the development of a valuation of a stock or an asset could be in the future. So basically integrating ESG risks in traditional financial risk analyses. So the three main regulations that are important to consider with regards to the EU Action Plan on Sustainable Finance is then, of course, the SFDR, CSRD, and the EU Taxonomy. The CSRD is the new updated NFRD, Non-Financial Reporting Directive, so sustainability reporting regulation. This will have clearer mandates surrounding integration of the double materiality perspective in your annual sustainability report, as well as how your company is in line with the Paris Agreement, whether or not it is on target to be within those temperature increases. Is your company contributing or not? So again, this is a regulation on non-financial entities, but a lot of the requirements that are set within SFDR will also align with CSRD, so that the requirements that are set in SFDR on financial entities will also then be complemented by the requirements that are set in CSRD, so that the non-financial entities or the assets under management can report up to its owners and investors the indicators that owners and investors need. The EU taxonomy sits a bit on the side. It's a classification system for green and sustainable business activities. What is often misinterpreted about the EU taxonomy is that it is a classification of clean tech investments or companies that are working, for example, with e-mobility or wind or solar energy. But in fact, the EU taxonomy focuses on the 93% of scope 1 emissions that are most intensive within the European Union. So the point of the EU taxonomy is to transition high impact sectors to become low impact sectors. So that is why, for example, cement and steel are very clearly included, but they also have very strict requirements so that they are then in line with the Paris Agreement and carbon neutrality by 2050. Did we have any questions or something? No? Yeah. Okay, it's on, perfect. So again, just ask questions as they pop up. We're going quite quickly and there's a lot of information. We'll also leave some time at the end for questions, obviously. The SFDR, Sustainable Finance Disclosure Regulation. This is the one regulation that we're focusing on today. It's a requirement then set on financial market participants. So what is important to know about the SFDR, we said it earlier, but we'll say it again, is that it's only a transparency regulation. It does not require a financial market participant to act in any way, but it is asking financial market participants to take a position on sustainability. So to summarize, financial market participants must disclose whether they consider sustainability risks material to the future valuation of a stock or an asset. If they do not consider sustainability risks material, they must also disclose why they don't consider them material. This also goes for principal adverse impact. So either you disclose that we are working with the negative effects from assets under management, and this is how we're doing it, or you disclose that we do not consider principal adverse impacts, and this is why we don't consider principal adverse impacts. When it comes to Article 8 and 9 products, which are then sustainability funds or ESG funds, these have some extra requirements above and beyond the regular funds, which sometimes are called Article 6 funds. There you have to also report how these sustainability characteristics or impact is achieved through quantitative indicators. You have to provide information on the sustainability index that you're using. If you are using a sustainability index, this is not required. And you have to be transparent about your investment methods and process for how you follow up on these sustainability characteristics and impact, and then report them annually in an impact report. which reports both then positive and negative impact. The SFDR is basically the double materiality perspective, but applied to financial actors. So for those of you familiar with double materiality, it has been a requirement for non-financial entities for a long time. It's basically for non-financial entities to consider what impact does sustainability have on the company and its operations, but also understand what impact does the company have on sustainability inside and out. So if we then apply this to the financial sector, you have then the climate impact of the investment. So how do you contribute to climate change with an asset that you have under management? And then you can also have the climate impact on the investment, which is then the financial risks. So what is your assessment of ESG risks and their potential impact on the assets under management that you have and their future returns that they will produce? We had a question.
We had a question from Jenny.
Yeah. Okay. Adverse impact for Article 9 funds, will there be a maximum level in terms of what? So principal adverse impacts will be equivalent for Article 8, 9 and Article 6 funds. So you have to look at, basically, first you have to report 14 mandatory indicators regardless, but then you also have to consider, okay, which indicators are material or specifically relevant for our fund. So there you have to pick at least 2 more indicators that are material to your fund and the types of assets that you have under management, whether it is biodiversity, gender equality, whatever it may be. When it comes to Article 9 and 8 funds, the important difference there with principal adverse impacts is that if you want to classify an investment as sustainable, again, EU's definition of a sustainable investment is one that is in line with the EU taxonomy criteria, then you also have to prove that that particular investment, which is contributing then to possibly the 20% of your fund that is sustainable investments, you have to prove that they are also not doing any significant harm to other environmental objectives. So if you're contributing to climate change mitigation, you have to prove that that investment is not doing harm then to biodiversity, for example. And you also have to fulfill minimum requirements with regards to human rights and anti-corruption. So for Article 9 and 8 funds that you want to classify a certain portion of the fund as sustainable investments, there you have to look at principal adverse impacts a little bit more in detail. But for all funds, Article 6, 8, and 9, you have to look at principal adverse impacts in general. So these 14 obligatory indicators plus 2 that then are material to your fund. All right, but we'll get into that later in the presentation too. If we then look at the relation then between asset owners, asset managers, and corporates. So what we said earlier, CSRD is the regulation that is coming into effect next year and then will be reported upon 2024 by corporates. This will then incorporate a lot of the requirements that are set out in SFDR on financial actors now. There has been some criticism to the order of these regulations. Maybe the CSRD should have come first and then SFDR, but now we have SFDR first. So a lot of the indicators that SFDR requires, you have to ask then before the CSRD comes into effect from the assets under management in order to fulfill the regulation requirements. So you have corporates at the bottom, CSRD, and other assets. They have to report principal adverse impact indicators, other sustainability indicators, so that then the asset managers can fulfill these increased disclosure requirements for funds on their sustainability performance, whether it be then positive or negative sustainability performance. So the double materiality again, both positive, negative, both inside out and outside in. SFRD then, for asset owners, they will then also have to publish annual impact reports depending on the assets that they have under management. Important for asset managers is that you are very clear about how you implement and integrate ESG risks in your investment process. If it is so that you do consider ESG risks material for the future returns of the fund and the assets under management. There's a lot of text on this slide and we won't go through everything. We'll send it out afterwards. But what is important to take with you from this slide is that all types of funds, so both Article 6, which is not ESG or sustainability fund, have information disclosure requirements on in pre-contractual agreements, on websites, and in periodic reports. The only one that Article 6 doesn't have then is periodic reports. The main thing to see here is that whether or not you consider sustainability risks as material to the future returns of your fund, or if you consider principal adverse impacts, so the negative effects from the fund's assets under management, whether or not, whichever position you as a fund choose, you will have to disclose both in pre-contractual agreements, on the website, and in periodic reports what your position is. So it's not possible any longer to not have a position on sustainability. Either you do consider it, and then you must disclose how you consider it and which indicators you use, or you do not consider it, and then you have to disclose why do you not consider it and why do you not think it is essential in the world that we live in today. So if we go then a little bit deeper into Article 8 funds, so these are the ones that have a promotion of environmental or social characteristics, but do not have sustainability as its investment objective. So here, this is what maybe has been characterized as light green funds, or some traditional ESG funds that have been launched earlier on the market before there were any requirements surrounding disclosure, and exclusionary funds could, for example, be these type of funds. So sustainability is not your investment objective, but you have some kind of ESG characteristics that you're marketing and promoting in order to gain financial flows and to take your position on the market as a financial product. So for such a investment, so Article 8 funds, it's then must be aligned with certain environmental and social characteristics. So whether it is you're focusing on exclusions, or you're focusing on companies where there is a portion of gender equality in boards, or where you're focusing on companies that are transitioning to non-fossil fuel alternatives in their value chains, the supply chains. This is what you have to disclose then. What is your fund focusing on, and how are we obtaining this objective? Furthermore, you can also classify a portion of the fund as sustainable investments. So these are then investments that are directly aligned with the EU taxonomy. So these could be then 20% of your fund that are completely aligned with the EU taxonomy, and then you have 80% of your fund that simply is addressing these environmental and social characteristics that you have set, that are a bit more loose, and where you can decide for yourself which types of environmental and social characteristics you want to follow and address. When it comes to sustainable investments, you have to disclose whether they're then taxonomy aligned, or if they follow other environmental objectives. So the ones that have just been released when it comes to biodiversity, circular economy, so on, or if they're aligned with some sort of social objective. Here it is very important to have concrete indicators and clear evidence of how your investment is a sustainable investment. So here you have to prove, firstly, that it contributes to some sort of social or environmental objective, then that it doesn't do significant harm to other objectives set out by the EU taxonomy, and then lastly, that it fulfills minimum requirements with regards to the governance of human rights and anti-corruption. So the rings that you have to hop through in order to classify a investment as a sustainable investment are much higher today than they were only a year ago. But again, you do not have to classify an Article 8 fund using sustainable investment. You can also then promote certain environmental and social characteristics and show how you promote them, and just be transparent about the development of these indicators from year to year, just as you would with financial indicators. Important to note here is that if you're using exclusion criteria, you have to then very much explain how these exclusion criteria are affecting your investment strategy and the environmental and social characteristics that you're following. So if you exclude gambling, for example, how is that helping from a positive sense environmental and social characteristics? What is the indicator that you're tracking that is going up or developing in performance because of this exclusion that you're making? So we're, in essence, we're moving away from exclusion criteria to a positive inclusion investment process when it comes to ESG funds and sustainable funds. Article 9 funds then are funds that are clearly then have a sustainable investment objective. And here, if we go back, these must be then in the top category then, so sustainable, taxonomy aligned, other environmental or social only. They must have some sort of sustainable investment objective that is contributing to these goals that the EU has set out. You cannot just pick your own indicator here. You have to follow one that is within the framework that the EU has set, whether it is then within environmental, social, and then if it is within environmental, is it taxonomy aligned or is it contributing to some other environmental objective? When you have a Article 9 fund, you can be transparent about the fact that a portion of your fund then is not sustainable. So it does not classify as a sustainable investment, sustainable investment as part of the fund. But what is important here is that both within Article 8 and 9, there will be different types of funds within Article 8 and 9. So if we go back to Article 8, some funds will only be aligned with the ENS characteristics and won't have any sustainable investments. Some will have some sustainable investment, but mostly be aligned with ENS characteristics. Some will have a higher taxonomy alignment, and some will not have a higher taxonomy alignment. And it's the same with Article 9 funds then. All financial products will take a position within the spectrum of sustainability and ESG. There is nothing within the SFDR regulation that says you have to have a set percentage of your fund that is reaching sustainable investments or that is taxonomy aligned in order to classify yourself as Article 8 or 9. This is simply a process-based regulation. What is important, however, is that the market, so both institutional and retail investors, will be able to judge your fund based on the information that you provide according to these two decision trees that you see. So all investments, all funds will be able to be compared against each other on a comparable and uniform level. And this is the important difference then within the market that is happening now compared to before, when it was very hard to compare one sustainability fund against another. Which one is more sustainable? Which one is reaching the objectives that I, as an institutional investor or retail investor, is more interested in? Which one has a higher ambition than another fund? Which one is governing sustainability risks? Which one is not? which one is governing principal adverse impacts, which one is not. And all of this will also be expressed in the updated MiFID regulation. So with the suitability that the investment advisor must assess for a client that is placing its funds with their product, they will not only have to assess the risk profile then, but also the sustainability profile. Do you want to have a fund that is mostly taxonomy aligned? Do you want to have a fund that is considering ESG risks? Do you want to have a fund that is considering principal adverse impacts? And then the investor can basically make a decision based on those factors and find the funds that most suit their preferences. Here is then the list of principal adverse impacts that are obligatory for a fund that is disclosing principal adverse impacts. If you then, again, if you want to decide that we do not consider principal adverse impacts and the effect that the fund that we are managing has on nature and society, you can disclose that we do not consider these factors important or essential, and that is why we don't collect information on them. But that then just has to be reported transparently so that then the investment advisor or whatever other intermediary that is selling your fund can then disclose that your fund does not disclose or manage principal adverse impacts. If you, again there, so more than these 14, you also have to then report 2 additional indicators that are material to your specific fund, depending on whatever investment strategy it has at its foundation. Real estate funds that are only focused on real estate, they have 3 own principal adverse impacts. It's the same with sovereigns. So if you're investing in sovereign debt, then you have your own principal adverse impacts because some of these are not relevant for such asset classes. Something's happening here. Okay, perfect. But basically in general, all funds will have to report on these 14 information indicators. And the strong bet here then is also that these 14 indicators will be included in the CSRD, so the regulation on non-financial entities and what they must report on annually, so that the funds then can pick up that information and aggregate it. Here is an example of a template for how you would report then if you are an Article 8 fund. So you would basically report, so this is then going back to those decision trees that we looked at earlier, but just expressed in a different way. Does this financial product have a sustainable investment objective? So let's hypothesize here that the Article 8 fund that you're setting up does not have a sustainable investment objective, but it does promote certain environmental and social characteristics. So the right panel there on the yellow box, then you have to disclose also what types of environmental objectives these are those environmental objectives aligned with the taxonomy? Do you have maybe social objectives that you're tracking instead? If there is a percentage of the fund that that is made in sustainable investments. If it only promotes ENS characteristics but will not make any sustainable investments, you would just tick the box at the bottom right corner there. If you then have, this is just the same template expressed, but here to show that you have to report also how you achieve these targets. If they were achieved, if you actually completed what you set out to do. So this is a historical template. It promoted environmental social characteristics. And while it did not have as its objective a sustainable investment, it had a proportion of sustainable investments in these areas. It promoted ENS characteristics, but did not make any sustainable investments. And these impact reports then will have to be reported annually. The first such impact report will be published or mandated by June 30th of next year, 2023, for this year's reporting period. Here's the same template, but for Article 9 funds. So here then, does this financial product have a sustainable investment objective? Yes, it will make a minimum of sustainable investments with an environmental objective, then you get the percentage there. Are they in economic activities that are qualifying as environmentally sustainable under the EU taxonomy? Are they in economic activities that do not qualify as environmentally sustainable under the EU taxonomy? So important to remember here is that EU taxonomy is only classifying 93% of scope 1 emissions in the EU. So 7% are still outstanding. It is the EU's objective to also set requirements and criteria for these 7% of economic activities, but they are not set today. So it could be the fact that, for example, you're investing in healthcare, which is not included in the taxonomy today, that you could make an argument that this is a sustainable investment or environmentally sustainable, but it is not included in the taxonomy. And that is the same then for a social objective, as the social taxonomy has still not been adopted and is still hotly debated. Here is the same template then, but just historical, or actually no, I have two of the same slides. But yeah, for Article 9 funds, you will also have to report then it promoted or it made sustainable investments with an environmental objective. So both Article 8 and 9 funds will have to publish the results of their investment decisions, investment processes, and their active ownership. Here's an image showing how all these regulations sit together. So what we have focused on today is the right side, the Sustainable Finance Disclosure Regulation. So basically, does your product consider principal adverse impacts? Do you consider sustainability risks? How is your ESG or sustainable fund aligned with sustainability objectives or environmental and social characteristics? But the information for these funds will come from the left side. So what the corporates or the assets under management are disclosing to financial market participants and advisors as their reporting obligations under the EU taxonomy and the CSRD. So the CSRD will most likely require many of the same indicators that you now as financial market participants are required to disclose. And it will also obviously require large entities, so entities with 500 employees and which are listed or have a bond on the market, to disclose their EU taxonomy. So this is where the information that goes into the Article 8 and 9 funds will come from. It will come from the assets under management. And the financial products then, which are developed based on the assets that they have under management, the SFDR is simply just a regulation that necessitates that you show what is in the fund, how does it contribute to sustainability objectives, so that end users then, which are at the top, civil society, customers, analysts, citizens, retail investors, institutional investors, can see how does the financial product that I'm considering investing in or that I already own, how does it actually contribute to those sustainability objectives that I care about or have mandated in my policies. So you could consider the sustainability finance disclosure regulation for financial products very much the same as how you would describe, okay, so for example, for a food product, what is actually in this food product? How much sugar is in it? How much fat? Does it have anything healthy in it that I am interested in to eat? This is the same thing, but for financial products. What is in the fund? Does it contribute to social objectives? Does it contribute to environmental objectives? How much of it is aligned with the EU taxonomy? how much of it is contributing to principal adverse impacts or negative effects. It's basically just providing more information to the end user. And this information is then required to be provided. But what you do and how you promote your fund or how you work with your investment processes, that is completely up to you as a financial market participant, as an asset owner or an asset manager. So key considerations now going forward. So some of the SFDR requirements have already taken effect, especially then the disclosure of how you work with ESG risks and how you work with principal adverse impacts. But the Article 8 and 9 requirements that we went through today in a little bit more detail, they are not mandated until 1 January 2023. So there you still have some time. So good to think about then is, how does this fund integrate sustainability risks into investment decisions? How does the fund consider principal adverse impact? So the list of indicators that we had then there earlier. Does the fund promote any social or environmental characteristics, and how does it then do that? And then lastly, does the fund have a sustainable investment objective, and what is that objective? So yeah, start preparing for mandatory disclosure, especially then data collection, get those processes in place, as you will have to collect and disclose data. Developer update policies, website disclosures, pre-contractual disclosure agreements, so that they are in line with the SFDR requirements. And then for corporates, obviously prepare so that you can provide investors and owners with the data that they have to report according to law. Yes, so I think we can stop there at the summary slide and see if there are any questions. Otherwise, we're at the end right now. So basically, yeah, go ahead, Amanda.
Yeah, we'll wait a little bit for questions. If you have any questions, please write them in the chat.
So in summary, basically the SFDR and the CSRD and the EU taxonomy, like we've mentioned, it's all about enabling greater transparency in indicators that are not directly then related to financial performance. So in the same way that you as a fund or a corporate have to disclose your financial performance annually, now CSRD and SFDR is making sustainability information equally important to financial information. You have to report it just as consistently and in the same format as you would have to do with financial information. Then it is up to the market and investors, of course, to do what they wish with that sustainability information. SFDR applies to all funds, but there are some additional requirements for Article 8 and 9 funds. And principal adverse impact is not mandatory, but it is mandatory for companies or financial market participants that have over 500 employees. So there you would have to disclose principal adverse impacts regardless. But then again, the customer or investor, retail or institutional, could ask their financial advisor or other intermediary, does this fund consider principal adverse impacts? And if so, how do they do it? And then you would have to have an answer to whether or not you do consider principal adverse impacts. So there, the effect of that regulation is really market driven. If you're not, are then a company that has over 500 employees, because then you have to submit a principal adverse impact statement, as it's called. So reference benchmark or index, these are basically, so for example, if you're a fund that is an Article 9 fund, and you are disclosing that you are making a minimum percentage of sustainable investments, 30% taxonomy aligned, you could also choose to include a reference benchmark. For example, there are two that are provided by the EU. There's one called the Paris Aligned benchmark. And there you could show basically how is this fund performing in relation to the Paris Agreement? How are the companies or assets in this fund in line with the goals that we have set out in the Paris Agreement with regards to 1.5 or 2 degrees warming? There are also other reference benchmarks or ESG benchmarks that you could use. Some famous index providers are Vigeo Eiris, Sustainalytics, MSCI. You can also follow such indices in order to prove that you're following up on your performance. Today, a lot of those indices are below par when it comes to these regulations, but there will probably be new indices launched on the market in the coming months that are more in line with these new regulations. And then you can show how your fund is tracking that index in relation to sustainability.
Thank you. And then the question that we just answered was regarding, can you explain what a reference benchmark or index is? For those of you who missed that.
All right, if there are no more questions, I think we'll end it for today, and people can have a chance to email or also maybe just have some lunch.
Exactly. And our next series of lunch webinars will be hosted by Magdalena Frembeck together with our guest Stephen Tebbe. And it will be on the 5th of May at noon. So you're all welcome to listen into that as well. And we wish you a great lunch. And thank you all for joining.
One more, okay.
Thank you.
Thank you. Okay.
Thank you.
Thank you, bye.